Looking for a flexible way to generate income in retirement beyond traditional fixed income options like bonds? Let's explore a strategy you might not expect, using life insurance as an alternative asset class. I'm Alex Nameishi with Penn Mutual, and you're watching Edge Conversations. Empowering development, growth, and execution with insights from Penn Mutual's field leaders. Yes, life insurance, though not the kind most people think of. When structured a certain way, some policies may provide tax advantages, access to liquidity, and even serve as a supplemental retirement income tool. And because accumulation whole life insurance doesn't have a surrender charge and isn't tied directly to the market, it can offer valuable flexibility in retirement. When stocks are under pressure, income can be taken from the policy's cash value instead of selling equities at a loss, helping preserve the equity portfolio and potentially improve long-term results. You've probably heard the classic rule, 100 minus your age, to figure out how much of your portfolio should be in stocks versus safer assets like bonds. So if you're 30 years old, that's 70% stocks, 30% fixed income. But as you get closer to retirement, safety becomes a priority. With interest rates and bond performances shifting over time, many retirees are reevaluating their income strategies. One lesser-known option, properly structured life insurance, is a potential complement. Life insurance offers some big advantages. Tax-deferred growth, non-taxable income if structured right, no probate, creditor protection in many states, and no early withdrawal penalties as long as it's not a MEC. Bonds offer simplicity and avoid the cost structures associated with insurance products. However, they're subject to interest rate risk and may underperform in a rising rate environment. For some investors, the predictability may outweigh the trade-offs. Well, let's walk through a real example. Meet John. He's 65, relatively healthy guy, looking to create income for retirement. He's what we might refer to as standard in underwriting speak. He puts $1 million into a 30-year treasury bond, yielding 4.5%. After income taxes at 30%, he's left with 3.15% net, about $31,500 a year in income. Now, what if he used that $1 million to fund a life insurance policy instead? He splits the money into a premium deposit fund, earning 4.75%, then pays roughly $163,000 a year for 7 years. By year 30, he still gets that same $31,500 in income annually, but he also builds $1.54 million in cash value and has a $1.66 million in death benefit. Now that's real long-term leverage. But here's the kicker. He could actually take out more. That same policy could generate $39,680 a year for 30 years, and he'd still have $1 million in cash value at the end. In this case, he may even take out as much as $53,518, depending on policy performance, without collapsing the policy. Now, to get that kind of income from a bond, he'd need a 5.67% yield, which just isn't realistic in today's environment. Now, let's say John gets an opportunity to invest in his friend's startup, something he doesn't want to pass up. Instead of pulling from personal savings, he uses the policy as collateral to get a line of credit, up to 90% of the cash value within 60 days. His money keeps growing, his death benefit stays in place, and he gets to not miss out on an investment opportunity. Life insurance isn't just about protection. It can be a powerful financial tool when structured the right way. If this sounds like a strategy you or your clients could benefit from, talk to a financial professional who understands how to design these policies for growth and income. And hey, if this video gave you a new perspective, hit like, subscribe, and turn on notifications so you don't miss future insights.